Hey, good morning, options traders, and welcome back, everyone. And here's a good question that we got from one of the traders in our group. And he was asking, can you stack vertical spreads? And so what he was referring to is in a previous video, I had talked about vertical spreads. And he said, well, what if the stock continues higher? Could we put another vertical spread on top of this one? Or would we just need to close this one out and reinitiate a new spread? Well, the answer is yes. You can certainly stack them on top of each other, but you have to be careful about your cost basis and your resulting profit and loss diagram to make sure this is in fact what you want. So, for example, let's say that we buy the following vertical spread. We buy the $100 call, we sell the 105 call, and let's just say that it was for a net debit of 3. That's just the net cost between these two. And in the business, we would say that we are long the 100-105 vertical spread. And so this would be our resulting risk graph. So as I've always talked about on your risk graph, remember that you're going to get a bend at your strikes. So here we can see a bend at the 100, our long call, and a bend at the 105 strike. And because there's a $5 difference in these strikes, the most this spread could ever be worth is 5. So in this example, we paid $3 for it. If the most it can be worth is 5, then that means the very most we could put into our pocket or the profit would be 2. So this would be a potential 66% return on our money if the stock gets above the 105 strike. But his question was, what happens or what could we do if the stock goes above here? Let's say the stock is trading at 105 or 106 or 107, and we're going, I wish I had never sold this 105 call. Do I need to completely shut this spread down? Or could I open up a new spread and do the 105-110 or the 110-115? Well, let's take a look at them. Let's start with the 105-110. So recall that the first spread that we purchased was long the 100 call, short the 105 for a net debit of 3. And now on top of this one, we're going to buy the 105 and sell the 110. That's just the long 105-110 vertical. And let's just say that this was done for a net debit of 2. Maybe the spread isn't as far in the money when we initiate it. But the thing that you have to notice is that we are short over here, the 105 call, and we're long the 105 call. And you cannot be long and short the same asset in the same account. So those are just going to cancel. So take a look at what's left over. You're long the 100 call, and you're also short the 110 call. So when you execute this trade to buy the 105-110 spread, as soon as it executes, your account's going to show that you're long the 100-110 vertical spread. And what's the net debit? Well, it's just the total of everything that you've spent. 3 and 2 right here would be a net debit of 5. So even though we initiated this as 2 separate vertical spreads, mathematically it's the same thing as if we had just purchased the 100-110 vertical for a net debit of 5. And this would be our resulting risk graph. Notice that the bends have changed. We now have a bend at 100 and at 110. So the most this spread could now be worth is this $10 difference. So if we have a total of $5 into it, and the most it can be worth is 10, well, now the max gain is $5. So now, yes, on one hand, we've reduced the potential ROI to 50%, but we've also increased the total number of dollars from 3 to 5 that we could possibly make. But now let's back up to the original spread. When we're long the 100-105, what would happen if we bought the 110-115 instead? So remember that we bought the 100 call, shorted the 105 for a net debit of 3. And now the stock's running. But instead of buying the 105-110 and letting those 105 strikes cancel out, what would happen if we bought the 110 call and then sold the 115? And let's say that maybe this was for a net debit of 1. So we're putting this spread on when it's still quite a bit out of the money. What's going to happen now? Well, notice that nothing cancels. We have 4 different strikes, but we still have a total of $4 that we've put into the position. So our net debit is $4. So what would the resulting risk graph look like? Well, this is what it looks like. Notice our bends. Right here's our long 100 call. There's our short 105. Here's the second vertical spread. Here's the long 110 and short the 115. So notice that we have flattened this portion out between 105 and 110. And that's because our long 110 call doesn't start making money until the stock actually gets above there. So even though we are long the 100 and short the 115, it might give the appearance that the most the spread could ever be worth is $15, but we've got to subtract this portion out. We're not capitalizing on this. So it's really 15 minus 5, or $10 is the most that we could make. So in this example, because we spent 4, the maximum gain up here must be 6. So the answer is yes. You can definitely stack vertical spreads on top of each other. You could do it on top of covered calls, really any strategy. Because remember, all strategies are nothing but long and short calls and puts. The better question is, what is the resulting risk graph going to look like? And is that really going to be in line with your outlook? Does it give you a very good, favorable risk-reward profile? That's really the question. So for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course, all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.